does not, that starts to put things like the housing market itself at risk. So the abuses that we see in forbearance could be postponing payments, not saving them any money. But what if it damages the value of their home? Pretty stupid deal, right? This is probably the biggest risk that we have. And we know that people who need it should get it. And that's actually, as we said, a good thing for the housing market, because it helps the housing markets remain stable. But the weight of this could be very detrimental to housing. It could be very detrimental to the borrower because of their credit opportunity, like we discussed. And in addition to that, at least on the FHA, there is a facility, but on the conventional side, if that loan is not brought current somehow, and if the servicer continues to make payments and the investor doesn't get it, and if there is forbearance on this without a facility, that loan isn't going to be on the amortization schedule current, Andrew. So there's going to actually be a cost. If you look at how an amortization schedule works, every payment that's made, the subsequent payment has a greater allocation towards principal and interest. So if you miss payments for a year, well, in year two, you're not in year one, you're the amortization for year two. So when you start making payments again, compared to somebody who had been making payments, you're actually losing money every single month when you're making that payment compared to where you were. So there's a cost for this. There's a hard cost that people will be surprised by. And I think if they knew this hard cost, they might think twice about entering into forbearance when they don't have to. Because if the money's going to sit in your checking account, if you got the money, pay it. You're not going to make money in your checking account, but it's going to cost you in the amortization schedule.
And I know we just talked about this before, but Matthew Gavsey is fellow Long Islander, so I just want to talk about this. You mentioned, will the forbearance negatively impact on the borrower's credit report? Because I'm hearing different answers. So if
there are different answers but here's what the deal is that it's not supposed to negatively impact your credit score. But that doesn't mean that an investor wouldn't view that negatively when they view your credit report and they see no pay, because it's going to not show payment made. So when they view your credit report and they know that you've been in forbearance, I've been told by many lenders that they're not going to touch that loan. They're not going to do that. So, again, the bigger opportunity, the main thing is there's no financial benefit whatsoever for forbearance. There's none. Either the money sits in your checking account. And remember, it's not all the money, because the principal would have been there, or the principal would have been with the lender. It's only the interest portion that sits in your checking account, getting very little to no benefit. And then after a short period of time, 3 months, 6 months, even if it's a year, so what? That money still has to be repaid at some time in the future. There's very little financial gain on that small sum of money, but the cumulative effect on it has a huge negative impact, as we've discussed, on mortgage and housing. And the small benefit that you have by letting that sit in your account, it doesn't amount to anything financially. It's just letting it sit there idly if you have the money. Now, if you don't have the money, certainly, yes, do it. But the downside of this is the potential negativity on your credit, of opportunity, and lost amortization buildup on each subsequent payment that you would have made.
Yeah. So I've got actually an email from Dorothy. I've been getting emails from lenders stating that they won't refi borrowers that have a forbearance.
There you go. That underscores exactly what we've been saying. And